when Bitcoin crosses the $78,000 mark, it's really easy to just look at the chart and think we're all trading in this one massive, unified global market.
Right. It definitely paints that picture on the surface anyway.
Yeah, but today's deep dive is going to shatter that illusion entirely. So welcome in, everyone. Our mission today is to look past that slashy price tag and unpack the underlying structural forces that are driving Bitcoin's market mechanics right now.
Right.
When we're seeing this massive collision, we've got aggressive institutional buying, corporate hoarding, and a sudden regulatory wall that's literally fracturing global liquidity.
Yeah, it's a huge shift.
Right. So let's start with what happened overnight. We saw a massive drop and then this sudden slingshot back up. What actually caused that whiplash?
So that was a classic derivatives liquidation cascade. Basically, you had a bunch of over-leveraged traders get wiped out in a single hour. It was a $100 million liquidation cascade, actually.
Whoa, wow.
Yeah, which forced the price down to around $76,664. But instead of the floor falling out, the market just hit a wall.
A literal wall.
Exactly. On-chain data shows this staggering spot supply wall. We're talking 53,000 Bitcoin.
Man.
Which is worth roughly $4.1 billion. And it was just sitting right there.
Okay, so it's like a financial game of chicken almost.
Yeah.
You've got the derivative short sellers just barreling down the highway, and institutional spot buyers basically parked a $4 billion immovable brick wall right in the middle of the road.
And the wall won. Yeah, I mean, those institutional limit orders just absorbed the entire sell-off. So the short sellers got trapped.
Right.
They were forced to buy back in. And boom, you get a short squeeze that propelled us right back up to $78,573.
Wow.
And the key indicator hiding beneath all this is the Coinbase Premium Index.
Okay.
Which tracks the price difference between U.S. spot exchanges and the offshore platforms.
Yeah.
And it just flipped positive for the first time in 97 days.
Which tells us U.S.-based buyers are basically driving the bus now.
Exactly.
But why is American institutional capital suddenly so aggressive? And what's the trigger there?
Well, you have to look at macro policy. So the U.S. Treasury recently committed to minimum $4 billion per session bond buybacks.
Okay, right, to manage their long-term borrowing costs.
Right. And when a government aggressively buys its own debt like that, it's expanding its balance sheet. It's diluting the currency.
Yeah.
So institutional capital sees this debasement writing on the wall.
Sure.
And so they're jumping into hard assets to hedge against it.
But if all this institutional money is rushing in to escape currency debasement, where are they actually getting the Bitcoin? Because when I look at corporate treasuries right now, nobody is selling. I mean, they're acting like dragons hoarding digital gold.
They really are. I mean, SEC filings show public companies are just aggressively accumulating. Like Strive Inc. just added 1,110 Bitcoin to their balance sheet.
Yeah.
And MicroStrategy expanded its USD reserve to an astonishing $5.1 billion.
Wow.
Just specifically designated to buy more.
So that active trading liquidity is just evaporating entirely.
Yeah.
And now there's this new protocol fork making the squeeze even worse.
Yes, exactly. So Layer 2 Labs just initiated the eCash or ECX hard fork.
Okay.
And to get the 1.1 token distribution for this new fork, investors have to hold unspent spot balances.
Wait, let's pause there. So meaning their Bitcoin has to sit completely untouched in a specific digital vault to even be counted for the new tokens.
That's the mechanism, yeah. You can't actively trade and still qualify for the snapshot, so institutions literally have to freeze their accounts.
Wow.
Which just sucks massive amounts of tradable supply right out of the room.
Just as demand is spiking?
Exactly.
Doesn't that effectively manufacture like an artificial scarcity crisis?
Right.
And you've got corporations trying to accumulate at the exact same moment.
Yeah.
A network upgrade is financially bribing people not to sell.
It creates an incredible supply crunch. And while the available supply is shrinking, the underlying plumbing of the market is actually cracking.
What do you mean by cracking?
Well, the European Union just dropped a sanctions package banning transactions on 14 offshore platforms.
Oh, right.
Yeah, including major ones like HTX and XMO.
So they're completely severing European banking rails from those non-compliant offshore order books.
Exactly. Meaning liquidity can no longer freely flow between those Eastern arbitrage nodes and compliant Western platforms.
So it's fracturing.
Yeah, the global market is basically splitting into two isolated buckets.
That brings up something really fascinating I saw in the physical infrastructure data. Because there's a company, BTC Digital, building a massive 10-megawatt facility in Georgia.
Oh, right, yeah.
But they aren't just mining Bitcoin. They're deploying these liquid-cooled dual-engine servers that can toggle back and forth between Bitcoin mining ASICs and GPU clusters for enterprise AI computing.
Yeah, it's a huge shift in the infrastructure.
But why go through all that trouble? I mean, is this just a cool tech upgrade, or are they being forced into this because that offshore liquidity you mentioned is drying up? If Western regulation is building this walled garden, isn't this more of a mandatory survival tactic for infrastructure providers?
It absolutely is a mandatory survival tactic. If you're operating inside a highly regulated, compliant Western venue where liquidity is ring-fenced, you just can't rely purely on global hash economics anymore.
Right.
Because when mining margins tighten inside that walled garden, you need the ability to basically flip a switch.
And generate steady fiat revenue instead.
Exactly, by leasing high-performance computing to AI developers instead of just relying on Bitcoin.
Okay, so the big takeaway here for anyone navigating the market is that global Bitcoin liquidity is officially an illusion.
I would say so, yes.
We're looking at a fractured landscape now.
Yeah.
It's divided into compliant Western institutional venues and these isolated offshore networks.
Yeah, the underlying structure of the market has permanently changed.
Which leaves us with a pretty wild thought to mull over. I mean, if massive infrastructure facilities can now seamlessly flip their power between hashing for Bitcoin and processing enterprise AI just based on whatever is more profitable that day.
Right.
Will future artificial intelligence demand ultimately dictate the base layer security of the entire Bitcoin network? I mean, think about that. Thanks for joining us on this deep dive.